All right, so today we're doing our typical Q&A slash backtesting stream. Do this normally 1 to 2 times a week. So if you got any questions from the previous week related to concepts or psychology or anything in general, you can put those in the chat and we'll try and get through those. I know I have a couple of questions from DMs and from general chat that I'll try and get through. If I forget any, please remind me. But to start us off, we'll kind of look at yesterday's price action and kind of some thoughts and things to learn from there, and then obviously go through the questions that you posted into the chat. So, um, quite a difficult week, I think, to start off. All right, I think most can probably maybe agree with that. Past 2 weeks, obviously since the start of December, as we expect, has been a little bit more difficult price action. It does not obviously have to be a losing month or something that you should fear or worry about. Obviously, we're going to kind of get into things that you want to be looking for that pertain specifically to December's price action. Um, but overall, it's different conditions than what you normally see in high quality months. So it's not going to be the same price action you see in the fall, not the same price action you see in spring, right? So as a result, you need to understand that there's a difference in those two types of price action, and what you're expecting and looking for um, doesn't necessarily need to change, but more adapt and adjust. As price action is difficult both on the higher time frames and on the lower time frames. So for this week, last week we both did a these kind of weekly outlook streams that I've been posting on Monday or Sunday of that week. So if you go back to the 8th of this week, 8th of December, which was the Monday, we posted a weekly outlook. We also did this last week on the 1st of December, kind of just walking through what I'm expecting throughout the week, kind of what days are high probability, any weekly profiles, just if there is any. And as we're currently resting at the higher time frame, kind of midpoint, or not exactly midpoint, but in a range with a gap above us and a gap below us, two higher time frame PD rays like that, and we're nested between them, you're expecting more consolidation type of profiles and weeks. All right. So to kind of list off the things that you may be having that's opposing you, you have obviously December PA, which in terms of seasonality is resetting the yearly range. So since we have a bullish year, and the high of that distribution phase is put in during November, you're expecting December to be either a consolidation type of month or preferably returning back to the yearly open, which would be in this case bearish, right? So that's the first thing. Second thing is obviously we're in a higher time frame consolidation. So it makes it a little more difficult to see things like weekly profiles. So I want to emphasize this and strain this because the tools that you may use in September or October, right, of maybe saying, okay, this is going to be Tuesday low of week. Once you see that, you see some sort of confirmation that's the low of the week, you're not building your bias off the emphasis that this is the low of the week. Okay. That's not going to be as useful in these kind of conditions because you're not going to be able to trust or identify clearly when the higher low of the week has been put in. It's not going to be as, like I said, it's not going to be as clear. So you cannot use that as heavily to weigh your bias. You have to rely on other things and different protocols as a result to kind of determine high quality bias and determine what days you want to be trading, right? And obviously this week we had kind of a whack news profile, economic calendar. So all those things considered, you're looking at this kind of walking into this week. Obviously we had a bunch of sell side building up from the previous week. I talked about that possibly being accumulation for the following week, which would be this week. Like I said, if you're generating most of your bias off of the idea of a weekly profile or getting that higher low of the week being put in this kind of condition, it's going to be very challenging. So what you need to find is not get better at that specifically, but rather find things that are always true in price action, whether it's December, whether it's September, April, Monday, Tuesday, Wednesday, Thursday, Friday. You need to have certain things or a list of things that maybe changes up as the days progress that gets you that correct bias. All right. So weekly profiles and things like that are useful in spring and in fall when those are very clean things to rely on and you can kind of get away with it. But the problem is that if you generate that as a bad habit, when you get into price action like this, where there is no clean weekly profile, then you're going to be struggling a bit and you have to go back to kind of more technical analysis and rely on things that obviously you should be using in tandem with that weekly profile, but maybe not so much in those clean months. All right. So I'm straining that because I had a couple of questions this last week about, how do we approach a week like this with biases going back and forth and how do you determine kind of high quality days? So I'll get into that right now. But basically, on the weekly outlook, I suggest you go back and watch that if you haven't already, because it's just kind of emphasis on the fact that before the new week opening gap prints or before you see any of the rest of the data, using the tools that you see before that price action prints, you can make assumptions about the rest of the week and what days you want to be trading. Right. So I'm going to pull up the economic calendar here for this week. As you know, FOMC was on Wednesday. And then we had some kind of scattered news throughout the week that made it a little bit weird, probably for most who have not seen something like this before, but nothing too crazy. Look at this economic calendar. Like I said, on the weekly outlook, we kind of assigned values to each of these, looking at Monday to Tuesday to most likely be the accumulation, Wednesday potentially to be accumulation or manipulation, and then Thursday and Friday most likely to be some sort of distribution in terms of the weekly not weekly profile, but weekly price action. All right. So it's not, as a result, it's not mutually inclusive that we have all these accumulation, manipulation, distribution days and a very specific weekly profile. It's two different things. We can make general assumptions about the price action we're going to see on these days based on the economic calendar that we're seeing and whatnot, to then assume that these days are going to be probably more low probability price action. And these days later in the week are going to be high probability type of price action, meaning one-sided clear delivery during the session that gives you multiple entries, either as pyramids or as multiple opportunities to get in towards some sort of higher time frame draw on liquidity. That's what we look at as a high probability day, is one-sided, clear, precise price action moving one way. High quality price action could also be a swing to Z profile, right? A swing to Z profile can still be clean in the essence of making the high during London, the low during New York, and then retracing back into the rest of New York. That could still be clean. May not be the best price action, but that still could be a high probability day for you if you know how to trade those days. Low probability days are ones that have a very challenging bias or do not seem to follow any sort of profile in terms of the day or the session, and price actions all over the place are very high resistance. Those are the days you want to avoid, obviously, in the week. Doesn't mean you can't trade them or anything, but I actually support the idea that you know how to trade these type of days so they don't scare you or fear you fear missing these days, but rather obviously understand them first, but then just narrow your focus to the highest probability days like Thursday and Friday of this week. So this is the exact picture we kind of use for the weekly outlook. So I'm just referencing this for the review for this week. And then you can obviously see the price action that unfolded on Thursday and Friday. I think, in my opinion, was probably the cleanest price action you saw all week. All right. So those are the things that are not inside the chart. And that is narrative. Okay. All those things I mentioned there builds in narrative. Before we even look at price action, before we even look at PD arrays, those are the things that you need to be considering. If you're not doing that, you are cutting yourself short and you're going to find bias and being correct in bias throughout the year to be challenging. Okay. So the main point of your focus should be, what are the things that are consistent in price action, regardless of the month, regardless if it's high quality or low probability, that's going to get me some sort of useful analysis that I can either read as right or wrong or whatnot. All right. So in terms of an actual, if you actually wanted to grade this as a weekly profile, this would be very, very close to the Seek and Destroy bearish profile. But either way, obviously, it's just a very tight range bound type of price action. For Friday, actually, let's go back to let's go to the daily chart really quick. Had some questions about this gap. All right. Do not focus or do not base your bias, just like how we said, don't base your bias on a weekly profile. Do not base your bias off of the idea that price action has to do something. Okay. Anytime you say price action has to do this, you're already you're already making mistakes. All right. Price action number one does not have to do anything. You're not going to tell price action what to do, to be honest. And second of all, if you're wrong, you're completely removing that possibility from your brain and filtering all data away from the idea that you could be wrong if you say price action needs to do this or has to do this. All right. So this gap up here, for example, it is sure it's an efficiency. I look at this technically as a breakaway gap because it's pretty close to that SMR. But an inefficiency on the daily time frame, a bunch of people were looking at, okay, this is the likely draw for for this week, every single day this week. And because this gap is here and it's looked at as potentially unfilled, everyone is, or not everyone, but some people are basing their bias on, okay, this gap needs to be filled in because there's no price action within it, or something along those lines. And then every single day of the week after that, they're basing all the price action on the 4 hour, the 1 hour, the 15 on this idea that this gap is unfilled. So now they're filtering all the data out that may suggest as to why price action would be bearish for the day or consolidating for the day or anything else. So this, this idea of unfilled gaps or price action has to go to here, rooted on nonsense, to be honest, is not enough of an objective truth to be basing your bias on all the time. All right. Because like times like this, where it may leave this as a breakaway gap and now continue to move lower and potentially attack, these lows down here. I'm not saying it's going to come all the way back for this, but you get the idea. All right. So on the 1 hour time frame, we have multiple runs. So FOMC is right over here. As you can see, it does not really create any sort of meaningful profile or much, just shakes up liquidity on both sides of the market. So a lot of just purge and revert, comes up, takes out the previous weekly high, comes back down, sweeps all the intra-week liquidity as well as some liquidity pools and relative equal lows over here. And then in the PM session for Thursday, eventually runs up and fails to take out that buy side on NASDAQ and also fails to trade into this daily gap. My thoughts are, if it wanted to get up into here and potentially use this as a reversal point, because since December is a bearish month overall, right, we probably would not be trading completely through this gap in the first place and go back to all-time highs. It's very low chance that we do that. If we were to do something like this and we're going to use this daily gap as the high of the week, potentially, right, assuming that you're not stressing that weekly profile, why wouldn't I have done it on Monday or at least Wednesday, given what we saw about the weekly profiles and whatnot, right? So as a result, that failure to get up into the daily gap on Monday, and especially on Wednesday, given that we're looking at that specifically as manipulation potentially for the week, indicates, and also on Thursday, indicates it's very unwilling to get up there in the first place, okay? So that should also show you that it's likely not to get up into there and you're not going to see bullish price action, and you should be really looking at what is likely to unfold given the 1 hour time frame, right? So another thing I want to mention here is the SMT. Obviously, you see between ES and NASDAQ at these highs. So SMT at the highs, failing to get up into the daily imbalance, right? That failure itself shows you that it's unwilling to get up higher. Starts to drop down on the 1 hour time frame and form this large new day opening gap. This is a bit harder to see if you're new, but notice the close here at 1600 on Thursday, and then the open at 1800 here on Friday. Creates this large new day opening gap. Price action trades up into it here at 2100, then at 1 a.m., then drops at 4 a.m. through a short-term swing low and creates this imbalance. All right, price then trades up into that imbalance in premium of that dealing range going into the 9 a.m. open. So looking at the 1 hour time frame, to me, the presence of the relative equal lows, the failure to get up into the premium PD array on the higher time frame, the respective bearish order flow institutionally on the 1 hour chart, and the fact that actually the entire week has been consolidating and failing to reach any sort of higher time frame PD array is pointing to the idea that Friday is likely to expand, given the weekly profile we just talked about, right? With these 2 days being used as distribution, and with the lower time frame, given the lower time frame meaning 1 hour time frame, order flow and ideas of where liquidity is resting and whatnot. All right. So looking at this, and why are we using just the 1 hour time frame here and not using higher time frames than that? Because if you were in some of these market reviews before, especially the ones in October, when those weekly profiles were clean, I was mentioning how you shouldn't always rely on 1 hour and 15-minute charts to build a bias, because of the fact that you have different assignments. And I want to try and explain this visually for those who benefit from this. But let's say you're looking at a weekly profile like this, okay, bullish weekly profile. There are going to be, the week may be bullish, right? But there are going to be days within this week that may be bearish or flat, right? Here's an example of a day that'd be bearish in a bullish weekly profile. So when you have clean weekly profiles like this, where you have a trending market, just using the 1 hour time frame sometimes isn't going to be the best idea to be giving you a good estimate of what price action is likely to do on that day in terms of expanding or being high resistance or low resistance, because you may be trading against that weekly direction. Now, when you do not have that, anything above the 1 hour time frame, the 4 hour time frame, right, the H4 plus is all related to those higher time frame ranges. So daily expansion, weekly expansion, things like that. So as we reference it, if I go to the 4 hour chart here, I think it's way harder to see any sort of clear bias from this price action, you know, compared to when you use a lower time frame, just looking at what the day is going to do on Friday. Because think about what this week is just doing. It's going like this. So there's not going to be any sort of continuation or continuity in the delivery of multiple days. Instead, you're going to see just Monday go like this, and then Tuesday go like this, and then Wednesday go like this, and you get the idea. So I'm relying heavily on the 1 hour chart for this week and last week to determine biases throughout the days, you know, so because it may be flipping back and forth, and I want to see a lot of data given the gaps and whatnot that I just showed here to kind of interpret where price action is likely to go for that day specifically, not expecting any continuity into further days after that, right? Also, if you want to look at the 3-day look back, kind of just looking, this is just a reference point of just looking at where the liquidity is from the previous couple of days. You also have, you know, from this way onwards, you have the relative equal lows here. I'm placing emphasis on the relative equal highs up here. But this, given this previous daily low on Thursday and previous daily low on Wednesday, both of which should probably be considered as, I don't know, strengthening a bearish bias. So all that for a bias, but I think that is the most important part in this review. If you're going to, you know, leave, I think at least if you listen to this part, this is the most important part, because everything on the lower time frame obviously is just pretty similar, and you can still learn things on a lower time frame, but understanding this part of it is the most important section of trading, because this is where the skill is determining bias, determining what days you're going to trade, what days you aren't. As soon as you get down to that lower time frame, the 1 minute chart, the 15-second chart, things like that, you should be knowing what you're looking for and what you're expecting. You know, if you're walking into the day and just expecting it to be, oh, I'm just going to get a trade if it shows up, you're doing yourself no favors. You're going to get swayed by the price action. You have any idea where the bias or the draw is, and you're going to be caught up in every single minor fluctuation on that lower time frame and get very confused as to where that draw is. All right, so to kind of transfer over our higher time frame liquidity pool levels, I'm just going to annotate this 1 hour gap, the relative equal sell side here, the previous weekly low from Monday over here, and then this Tuesday low right here. All right, so this is a previous weekly low. I'll mark this one out properly. But that is relative equal lows, sell side from Tuesday, just a discount sell side pool, and then the previous weekly low. On the 15-minute chart, as you look at this, I'll mark out midnight here. When you're looking at specifically the ranges of time of the New York open session, the London open session, the London close, you look at it like this, what profile would this be? A classic London protraction profile, given just those 3 profiles that you study. All right. So during the New York open session, runs up into the 1 hour gap and also sweeps 15-minute buy side liquidity here, creating the high of the session. This would be your turtle soup. Like I said, into the premium there. Also, you can measure it if you want to from here to here. Runs up nicely into premium. First premium rate, buy side liquidity right there. Tags it. And then obviously going into the 9:30 open, what are our key times you want to be considering? So Friday has no news. On non-news days, what are the main focuses of time, or the time slots that are going to be heavily injected with liquidity and have a lot of signatures in terms of algorithmic delivery? Would be your macro times, right? Not that I need to write it out, but macro times then become your kind of main focus for delivery and for entries. Not saying you can't use anything outside of macros, but a lot of times what you end up seeing is, especially at 9:30, you can have double Judas swings or some weird price action that makes it hard, where if you were to get a trade right at 9:30, sometimes you get stopped out right before it makes that move, and you might as well just wait an extra 20 minutes just to get maybe a not as great of an entry. Not saying that you can't get a good entry, but waiting for some of that price action to clean up and then taking a very clean trade after that, just to kind of narrow your focus down. So high of the session here being placed in during the New York Open time between 7 to 10. As you see, it is being also formed as a long-term high. Right, as soon as you see that 9:30 high coming up on the 5-minute chart and start displacing back down, you have this change in stay delivery short-term on the 5-minute chart. That should show you, okay, it's likely not to come back up for that 9 a.m. high. You also could be looking for things like SMT at the session high, which we should have. Yeah, over here. You can see with the with YM, right? So 5-minute change in state delivery drops down with displacement on the 1-minute chart. We'll go back into kind of look for more. See, I don't know why does TradingView do this sometimes? It's kind of annoying. Your 5-minute change in state delivery, like I said, going into the macro time. So that sets you up nicely for any shorting opportunities. And here, and this is obviously, we had a tape reading stream yesterday for this price action. So if you want to go back in real time and kind of watch what I was looking at and analyzing throughout the session, you can go and do that. But I'm going to try and summarize the things that I was pointing out to in that stream. So like I said, 9:30 comes up into premium, forms that SMT, drops back down. What would this gap be here? Given it's close to that SMR and not completely inefficient, you look at this as a breakaway gap, right? Drops back down, forms a short-term swing high here, drops down again, and you have your first presentation SIBI forming here, okay? This is a breakaway gap. So is it going to be used as an inefficiency or a SIBI? No. So when you're marking out your first presentation for value gap, and as you get more practice with price action, you'll know kind of the difference between the two. Either way, you could still mark this out as a gap, and you could still mark this out as a regular fair value gap too. The labels and assignments you having per that perfected really does not matter, but more so just emphasis on the fact that this is our first presentation imbalance. It's our SIBI, first presentation SIBI, excuse me. So you can see how it's leaving this area of balanced price action, this first displacement candle. It's leaving all of this, right? So that is a key PD area that you'd be watching to see, does that have a reaction off of it, especially the fact that you pair this with a bearish order block. Price trades up into it at 950 with a bearish order block here and this inefficiency. So you'd be watching to see, does price action want to react off of that level and actually give you a short opportunity off of it? Otherwise, what is the assignment? If it's not going to be used as a reversal type of price action, I mean, if you don't see a breaker kind of set up like this, you're going to instead see what? A retracement. So back into premium, seeking liquidity or an imbalance, and then you see kind of a sell-off after that. So notice how in this leg between 939 and 950, you have two PDREs that are in premium. The short-term swing high here, and you have the imbalance here. So remember, for retracement opportunities, there does not always have to be an imbalance to here that price is trading into for price to deem that as a meaningful retracement. It's just looking for a couple of things, right? Premium, fair value, and then some sort of POI in the form of a bias or liquidity pool or an imbalance that price should be trading up into to then obviously restart that new sell program here, right? Because it's a short-term buy program. It's going to re-enter that sell program after it sees some sort of disruption in the market or a disruption in order flow. So that purge on that short-term swing high during the macro time either can be used as a shorting opportunity, but if you don't like selling it on buy stops, then you could wait for a different type of continuation or for value gap entry after that, which is what I'm just doing on stream there. Because just imagine this was like a 15-minute chart, right? And say this was right here is 9:30. Well, at 9:30, we open up, we sweep the bias of liquidity and premium, and then we sell off. So that's like the same exact signature you would see on a higher time frame, right in here, right on the 15-minute chart here. Same exact thing going on here. There's no imbalance on the 15-minute chart that it's trading into, but instead it's sweeping liquidity pool in premium of that relative dealing range, right? This would be this, and then you have this one. That's the first premium, right? Tags that, sells off. Same exact thing you're seeing here fractally, all right? So as price is trading up here, don't forget about this imbalance. This is what's called a reclaimed SIBI. So because the assignment here was the idea that price needs to retrace back into premium, it's not going to, it's not necessarily disrespecting this gap. It's not making this an inversion for value gap, but rather the assignment is it needs to get to premium. So anything in its way in this point is just, it's not going to be used at that current time. It's going to be trading up into this price and this premium PD array. And then after this point, now that it's actually in a sell program, it's going to use sell or bearish PD arrays as, you know, those opportunities and a support for lower price action. So still remember this inefficiency, and I've extended out in time. And this is the PD array I was looking for on stream here, which is as soon as we have this run on stops on displacement now here at 10 o'clock with that short-term shift in market structure, displaces and it trades up into the FPFEG. I was saying on stream that, okay, I'm going to watch the lower portion of this first presentation gap. If it holds below consequent encroachment, I will be looking for a change in state delivery out of that and then shorting opportunities as a result. Okay, you can go back into that video and just skip right to 10:01 a.m. And it'll be right there. All right. So as it trades up into the lower portion there, you can see the fact that it was holding this inefficiency. So to me, I'm just gauging what I'm doing here is I'm just gauging price action's willingness to sell off, right? Are we actually now in a sell program? If I trust we're in a sell program, any sell PD array that I see, gap, order block, SIST, whatever, can be used as an entry point, and I can get in, place a stop, and just ride it until time and price, right? So as it runs this short-term swing high, as it displaces the short-term swing low, as it holds now a reclaimed SIBI, those are all things indicative of a potential sell program, right? And especially after we already have the bias of it being bearish, that should already be strengthening the idea. So there's only, you don't have to see every single PD array and sell program indication in the book to be going short. I'm just looking for a handful of things that I know, okay, this is what it should be doing. If it's doing that, I feel really comfortable taking a short. So as at 10:01, it trades up into the FPFEG. Notice the candle closure closes back below this inefficiency, and it's using it as the SIBI that we wanted to in the beginning. Then up in here at 10 o'clock, it runs up, it opens here, runs up into that actually inefficiency it created here. Not 1 hour, but you can see the gap there, right? Trades up into that, and then on a 15-second chart, I was looking for a SIST change in state delivery outside of that FPFEG retrace. So as it retraces up into it, it holds it, and it gives me this change in state delivery here. That is already what? 1, 2, 3, 4, 5 things in line with a sell program with already a pre-existing bearish bias. That should be plenty. So I don't expect it to come up and run out this short-term swing high again because it's in that sell program. I don't expect it to come back to the breakaway gap. I don't expect it to come back for that session high or be bullish in this case if I'm seeing all these things lining up. All right. So I'm getting in here at I think 10:02 or 10:02:30 maybe. I have to go back to the screenshot. I'll pull it up. Stop was, I believe, at the swing. I believe at the swing high. It was either at the swing high or it was at the open of the candle that created this fair value gap here. Either way, stop was placed in, entry was in, was off a sell stop order, and then I had partials on layered throughout the sell side liquidity pools. So my first partial opportunity was these relative equal lows here. I was just keeping this in mind just to take a small partial off in case we wanted to come back into the range and consolidate, do something weird, just something to pay the trader for. That gets run out during the macro time. Then you see in here another shorting opportunity if you want to take that. Another shorting opportunity in here as it trades into premium nicely, right into premium there at 10:11. And then you have all these kind of continuation sell programs and PD arrays. And if you wanted to go back and specifically look at certain things, like I said, that tape reading stream is up, but continuous sell programs sell PD arrays all being offered as entries during Silver Bullet. Eventually runs back down into that previous daily low pool that we had at 10:24. And then it comes back down and runs into the sell side from Tuesday down at 1028, and also actually into a daily inefficiency that I'm going to mark out here. Okay, so if I go back to the 1 minute chart, you can see it's running into this daily inefficiency at 1030. Oh, actually, sorry, it doesn't run into the daily inefficiency. It runs into it later, but it approaches the daily inefficiency. So obviously in a bearish market environment, you know I've drawn this out every single market review stream, but you have time dynamics in a high probability session, opening range being placed here, 9:30 to 10 and 10:30 to 11 form the low end of that range. So that becomes our kind of time draw, and our draw on liquidity obviously needs to line up. So I'm taking partials at those relative equal lows I pointed out, taking partials at the previous daily low here, this ERL, and then taking partials at 1030, and it sweeps this sell side, as this would be this swing low. As soon as it makes the swing low, this constitutes a potential low of the session and a potential reversal point. All right, I didn't get this rest of the move and all the way down to the previous weekly low, and I could blabber about how I missed the move and get greedy and whatnot. But this trade by itself was about a 7R, so obviously I can't complain about that. And there's always things that you're going to be looking at to improve on, and different people taking different executions and whatnot. But walk away with obviously what you did for the day, no regrets, and it should be something that you review on later. But I'm not going to come, take more entries and get greedy and look at the fact that, oh, of course it wants to drop 600 points now after I close. Nothing productive about that, right? So I took it off here, closed out my last position at 1030, and then that was it for me. I'm going to show you the screenshot, and we'll kind of go through the rest of the session here. But here's a screenshot if you care. This is taken on stream like we talked about, shorting it, pyramiding, partials, pyramiding again, partials, and the last exit you see there is right at 1030. All right. So even if you miss those entries, you have an indication here as it runs out that sell side pool, in discount of that dealing range. You're looking potentially, does it want to reverse as you expected at 1030, or does it want to give you a retracement? Also notice between our last manipulation leg for the session, this manipulation at 9:30 gives us this -2 to -2.5 right here. So this is, if you know anything about your deviations, this is our range of a expected reversal or retracement. So as it tags that with time, with ERL, with the -2, -2.5, I think this is a phenomenal exit. That's perfect in my book. So I'm not disappointed with my exit there. But if you're looking at this, I don't know that it's going to obviously sell off again for another 40 points or whatever, but that's something that you should be looking for, is just alignment of time, price, and standard deviation. That is one of the best exits you can get in the book. Also notice this -4, -4.5 right in here, creating the low of the day. But like I said, it can create retracements. So if you miss the shorting opportunities all in here, and the fact that we have no news, you're looking at the idea of, okay, is the 1050 macro going to be used as another short entry? And what could you be looking for in this scenario to be potentially trusting that, okay, it wants to go lower and it's not going to outright reverse at this point? You have dealing range here between this swing high and the swing low. Doesn't really matter too much if you select it from this high or not, but dealing range here, okay, premium and efficiency. Either way, it's just displacement. So you should be able marking out this gap. It should be pretty easy to see, right? Gap and premium, okay? Does it show you indication at 1030 that it's going to reverse and come back into the range aggressively? No. Why not? Because if you were going to reverse at 1030, what are the PD rays that you should be seeing that would be telling you, okay, price action is done with this move lower. It wants to come back and rebalance maybe into premium. You would probably see a BPR here, right? You see an aggressive market structure shift, an aggressive change in state delivery. You see displacement with BISIs forming. You would see breakaway gaps forming. You would see no respect of these bearish PD rays and no closure, anything less than above consequent encroachment. So the lack of something, just like how we saw in the higher time frame, the lack of something, therefore, also can show you the willingness for price to move in one way or the other. So the lack of it, forming any BPR or breakaway gaps or displacement or a strong shift and just having this very high resistance move up shows you, okay, it probably wants to come back down. And obviously you pair that with bias and time, something of interest. But you're generating all this relative equal lows down here. You have our previous weekly low with our standard deviation lower, and you have now 1 minute price action that's showing you in relation, obviously, to the 5 minute price action. It's already very bearish with a 5 minute gap there. It probably wants to sell off again. So it trades in a premium of that dealing range, like we said, here, runs up into it, and then right at 1050, this is 1050 right here. So it comes up, trades into, it's already inside the gap, but it trades up into consequent encroachment of the gap, and then it sells off aggressively and eventually sells off all the way to the previous weekly low during the macro time, gives you that exit, and then eventually to the -4, -4.5 right before lunchtime, and then eventually it kind of consolidates and trades inside of that range for the rest of the day. So overall, a very high quality, I think, price action delivery on Friday, which was assumed already from Monday. And you should be, like I said, learning to see if you can develop that kind of skill before Monday even prints or before the Sunday new week opening gap prints. Can you already kind of create a game plan and a protocol for that week of what days you want to be trading and what days you want to spend a lot of focus on? If you can do that and separate the losing days, accordingly, you're going to have a much better equity curve this month and other months than you would have had otherwise. All right. So in both the lower time frame perspective and the higher time frame perspective today, I think or not today, but yesterday, it lined up very nicely. And it kind of generates a little bit more of a sentiment going into next week. But obviously, don't be too fooled just by the displacement away from the range. So that's kind of the mark review for yesterday. Now I'm just going to go through the questions. Like I said, if you have any, you can post them into the chat. We'll try and get through those, but hopefully this part was insightful nonetheless. Flux, could you please answer this question? If there's enough time, I won't be here for the answer because I must work. No problem. London close macro often performs a reversal or a retracement of the morning move. Are there also specific times when I should look to see, when I would like to see the move end, draw on time, and when I would like to see the reversal retracement to start? Just like you want to see the low of the high session be put in by 10 for the New York open move. Okay, that's a good question. Typically that London close reversal, you're looking at 11:30 onwards to kind of create that move. So 11:30 normally will be running stops against the expected lunch direction. You see that kind of take place, and you have an expected draw for the lunch session. That's really what you'd be looking for. So normally by 11 o'clock-ish, people call that take profit hour, but 11 o'clock-ish in a very high quality day where you have a nice profile, that's kind of where you would expect it to finish off and weather out. And then you see 11:30 normally start the move into lunch. Not saying that it's going to be a reversal all the time or a retracement all the time, but that's the key times that are associated with the specific move you're talking about. But like I said, don't place too much emphasis on, okay, this is the key time, it's going to reverse or it's going to do this. You pair it with narrative and bias and what the price action is already telling you, then yes, it becomes very high quality. But yeah, you're looking at really just that lunch move. Lunch macro starts at 11:30, and it pairs nicely with the end of London close. So that's kind of what you'd be focusing on for that specific move. Right? Yeah, Mr. Wade, let me get to your question. Give me 1 sec. That's a lengthy answer, so I'll save it. Interstellar asked, a really great weekly review and Friday review. I appreciate it. You know the answer, but this week was a consolidation reversal, correct? I know you said at this time, don't put much emphasis on weekly profile, which is a big part of my trading. However, I just want to confirm, of course. So, I mean, I look at this more as a seek and destroy profile, to be honest, because it's not like it's, you could say it's a consolidation reversal profile, or you could say it's seek and destroy. I think based off what we're seeing here, it's more evident of seek and destroy because of the fact that it didn't really leave relative equal highs or lows going into Thursday to create that reversal point. And also the Thursday reversal, quote unquote, is happening at the close of the market. Normally with the consolidation reversal, Thursday New York session or maybe London close at the most is creating that purge on the intra-week highs or lows and maybe into that higher time frame PD array. And then you see continuation. You can basically, in theory, you could be shorting it on Thursday, holding it into the Friday continuation. And then Friday PM session has the TGIF. So I would look at this more as a seek and destroy profile, just given the fact of how all of this is playing out, in this back and forth, sweeping back and forth over and over from Monday all the way to Friday. But interpretation really is up to you because, like I said, it's not going to be as important for this week. Just more kind of a backtesting review standpoint. Then that's the way I would look at it. Perfect. When I have a bearish bias, how do I know that price will not reverse from a bullish PD array? How do I know when it won't reverse from the previous weekly low sweep and go down? It's a good question. Okay, let me answer that. Let me answer this other question really quickly too. What is the best for backtest is using replay mode and tape read. I think, to be honest, the best thing you can do for backtesting is just not even use replay mode. Replay mode is forward testing. Backtesting should be going back in the charts that are already printed and taking screenshots and learning it from there. So I think I've been a big supporter of this method, which is you get a bias in the morning. Okay, you type it out or you screenshot it so you have some sort of record of it. You tape read. After the day is finished, you go back into the charts, you delete everything off your chart. Okay, make it completely fresh, make it completely clean. And then you go back from the higher time frame to the lower time frame and re-annotate it as if you were marking it up perfectly. And what you should be doing is, as you're marking those PD arrays up and price action and points up and everything, walking yourself through and talking yourself through what the algorithmic reason as to why it's doing this over this and how you should be getting this bias over that makes it so that backtesting session is beneficial. So what you're doing is you're looking at your problem set, and you're making a guess of what the bias should be. You're tape reading it to kind of learn how that lower time frame price action prints, and then you're going back at the end of the day to make your answer key and correct any mistakes that you made in the logic, not correcting any mistakes on your bias being right or wrong, because who cares about that? You should be concerned with what is the process and the logic that I use to get to my bias. If that path is skewed up and it takes you way longer to get there, or if you're constantly conflicted, you got to straighten out that path to get to the direction you want in the quickest and cleanest and most reliable way that you want. All right, and you have to kind of generate that logic and build on it and maybe change it up, what things you use in order to make it work. All right, so we'll look at ZKX's question next, and I'll get to you, Mr. Wade. So he was asking, when I have a bearish bias, how do I know that price will not reverse from a bullish PD array? How do I know that we won't reverse from the previous weekly low sweep and go down when I do change my bias? Okay, so it's a good question. And what you're dealing with here is, I would assume you probably come from some sort of retail trading background, or you're newer to the ICT concepts, which is this idea that it's more pattern trading than it is logic-based trading. So if you haven't had a lot of experience in the market, this is perfectly reasonable. If you have had a lot of experience, then I would probably assume that you're from a retail trading background. But PD arrays do not just constitute a reversal just because they're a PD array. Okay, previous weekly low does not constitute a reversal just because it's some sort of sell side liquidity. All right, you don't see the market pinging from higher time frame to higher time frame PD array just because, oh, this is a gap, or this is X PD array because I said it was. It's more so the narrative and logic and bias that you develop first, and then you go into price and reference, okay, what are the things that would line up with that bias that price action is likely to draw to? Because this is all the price action you see here is just a signature and just kind of the translation of what's going on behind the scenes, quote unquote. So what you have to be doing is, okay, reading kind of through the charts in a way, not to make this weird, I guess, but like you have to read through the charts, and then you take that analysis and translate onto what are the PD arrays that would support my bias. So just because it's the previous weekly low or previous daily low or previous session low does not mean as soon as it tags it all the time it's going to reverse. You pair that with your bias. You say, okay, this is what my bias is saying. I'm thinking that it's going to be a premium PD array here in the form of a 1 hour gap. So I'm going to be looking for sell side ERL, IRL to ERL. You look at the previous daily low, you look at sell side here, you look at sell side here. Okay, if you have a bearish bias, and this is where time plays in heavily, but if you have a bearish bias, right, and you're looking at things like this, so runs the sell side, how do I know it's not going to reverse? You look at things like order flow and its response off of it. So if I see this higher resistance price action coming off of it, it's less likely it's going to be reversal, compared to other times you have a nice sweep on buy side or sweep of whatever, and it energetically runs away, forms these breakaway gaps. That's something that you'd be saying, okay, that's maybe something I want to look at as a reversal. But it's always paired with time, number one, and price, number two. So at a key time at 9:30, if it's making that sweep and you see that kind of reversal, that's something you'd be looking at. Same thing with exits. So this is where DOT plays heavily into it. I'm not going to get too into it, but if you can understand what time price action is going to make the low at, it's less so important that you understand what PDRs are going on or what PDRs is going to tag into, right? If I can say, okay, I'm going to be short now until 10:30 or short now until 11 o'clock, it can go 30 points, 60 points, 300 points, 3,000 points. But until it hits that new time of day, it will not continue. It will continue to displace and deliver until that time of day. That's why the PDF is available, obviously, and why it always has 5-star reviews. No, I'm just kidding. But it's something that you have to just kind of develop as a student and understand through price action of, okay, if I have a bearish bias and I trust it, I'm obviously going to have swing lows before that it has to trade through. I can show you just from from Friday's price action, just all these sell side pools. It's like, how many does it run through before it finally makes that new low? In here, right? So runs through this quickly, runs through this quickly, runs through this. You have a nice retracement, and then it runs through the previous weekly low, and it actually goes through that. So just because these are time-based pools of liquidity, and just because you're sell side in a higher time frame, doesn't mean anything by itself. You pair that with projections, you pair that with time, you pair that with narrative, bias, etc., to the point where okay, I'm expecting to go through this sell side. And I think market experience is really just the only thing that's going to help with that. You just eventually you ride the bike with training wheels enough, and you just understand, okay, I can trust my balance at this point. So if you're newer to it, that's perfectly reasonable and just something that you develop as a student. But I would say focus majority on time and price and how that delivers on a consistent basis during the New York session. But if you want things that are more visual, which I know the newer and intermediate student likes a lot, this is something that you'd want to be studying. Is it tags that sell side pool, and it's a very high resistance move off of it, pair with the bias and pair with the fact that you have no indication that it wants to move higher. That's something that you want to be studying. All right, so hopefully that helps. Okay, so for Mr. Wade, I come back to your question. So he said, can we talk about risk tolerance, how to gain more confidence in the market to become more risk tolerant? So risk tolerance is something that is a slippery slope to go onto, because obviously anytime you deal with money, it has the possibility of not breaking you, but lingering too long into your brain that it makes a problem. Because anytime you talk about money or the money side of trading and you focus too long on it, you then become outcome focused instead of process focused. So risk tolerance is still an important thing to talk about, because obviously as you scale, you need to have a higher and higher risk tolerance. The way that I look at it is, at least I think as you gain experience in trading, and especially dealing with larger and larger numbers, the number no longer really matters as much as it did before. So there's a contrast between how much those numbers matter than it is more about drawdown and percentage, So like if you think about it, a $10,000 trade or $10,000 risk out of a $100,000 account is the same thing as a $100 trade out of a $1,000 account. All right, it's still the 10th. So when you think about it in percentage wise, I think it makes it a little bit less scary. The numbers obviously there is bigger by 10 figures, but percentage wise it's the same thing. So if you really trust the numbers, I don't think it becomes as scary, and as a result your risk tolerance makes it easier for you to grow and scale. So you may use 150 risk in the beginning, and then as you scale up to 300 risk, sure, it's going to be double what your risk is. And if you place emphasis on the fact that, oh my gosh, it's $300, it's going to feel scary. But when you think about, okay, well, actually my entire equity curve doubled by this time, so I'm actually using the same percentage. And if you think about how long it's going to take you to get out of drawdown, which you shouldn't really, but just bear with me, you cut it in half, it's still going to take you the same amount of time in a 2R to get back to where you were. So risk tolerance, I think, is really understanding, obviously, more about the numbers and how percentages work than actually just scaling into trades. But also it is just about lifting the weights. So eventually, as say, like, think about taking partials, right? You take partials very slowly in the beginning, very quickly in the beginning, and you maybe leave one contract all the way down to your full TP. And then as you lift that weight over and over and over again, your mental strength increases to the point where you can hold, 3 contracts down to your full TP, and you're only taking one off at your partial. So risk tolerance should be scaling with you as you increase your skill in trading. And normally what happens is you become less and less affected by that number, which, like I said, is a slippery slope, because then what ends up happening is you have no grasp of money. And as a trader, it just kind of seems you have no attachment to that figure amount anymore. Like like, I don't know how to describe it, but like $100 now and $100 back then, seems very differently. Now in the real world, it's the same. If I'm paying $100 for a burger, obviously it's going to be a problem. But I'm trying to say is, like, you don't really think about, oh my gosh, that's $100 right there I'm looking at, because that money is not real until it hits your bank account. So when you're dealing with unrealized and realized losses and just looking at that number, like I said, if you place too much emphasis on it, has that possibility to kind of derail you, especially if you haven't dealt with that kind of numbers before. But it really comes down to desensitization and repetitive action over and over and over again, just to build that kind of mental muscle to the point where you can slowly scale. And if you think about the percentages at the same time, I think it makes it easier to kind of get adjusted to that, right? So as much as you can kind of just look at the numbers and see other people doing well, sometimes helps you, in theory, get more adjusted to it. But I don't think that's the best way to do it. Like, I don't think I'm never going to say go and look at some crazy trader's risk and just get desensitized to that, because I don't think that really works. But yeah, more experience, more percentages at the end of the day, then it just becomes a number scheme, and you realize, okay, that's the same risk I'm going to be using, and it's going to take the same amount of drawdown to get out of, and blah blah blah. Where now $5,000 trade technically is the same thing as a $50 trade, depending on what your account size is. So I think that helps, but it is something that is challenging because money is deeply rooted to survival for humans. So, like I said, anytime you kind of think about growing that money, or now risking larger and larger, if you have still an attachment to survival and money and making money in trading, that's going to be extremely difficult to decouple from your brain. So I can kind of give as much experience and wisdom as I can about it, but that could be a whole hour lecture by itself, to be honest. So yeah, hopefully that helps. Any holiday specials for tier 2 sub? I may put one up for the Christmas season. I'll think about it. Maybe run another like 25% off everything sale. Yeah, we'll see. Maybe next week we'll start it off. Just remind me. At Flux, with bearish bias going to New York, any signature of a specific higher time frame PD raise to know that there's a high probability that the London high is protected when aligning myself with London protraction model. Also, during the retracement to that higher time frame PD rate from which we're going to take protraction trade, what if a 1 hour fair value gap forms while retracement? Okay, so I'm going to answer the first part of the question first. So if you have a bearish bias, what are the signatures you look at to see when the London high is protected? Okay, so assuming you have the bias, I like that you included that. You're looking for SMT, looking for that higher time frame PD rate, preferably on an H1 or M15. Well, it'll be H1 if you're talking about classic London protraction. You're looking for some sort of change in state delivery or a shift after that, and you're looking for bearish PD raise to hold as a result. Okay, so you have higher time frame PD rate, SMT, confirmation of reversal through the change in state delivery or market structure shift, and then further confirmation of reversal with bearish PD raise holding, forming and holding as a result. So that's the first part. So for the example here during the London session, you're looking for those things. But then the second part of your question, which is if you see that 1 hour gap form to retrace. So basically, like if you're in this case, if they're BISI formed here, if a BISI formed here, I don't think that itself will make or break your bias, especially if you've done the proper higher time frame to top-down analysis. Maybe something to consider. But if you already have seen a 1 hour change in state delivery, if you've already seen, other things like this all kind of line up, I wouldn't be concerned with the 1 hour gap or 15-minute gap while it's retracing. Now, something you probably should be aware of is if that 1 hour gap here is forming on the upside after it's tagged into some sort of higher time frame PDR here, then that would make me consider, okay, maybe my bias is wrong, or I have to incorporate that data into kind of debating the other side. But as you look on the 1 hour chart here, to kind of just use this as an example, there is no higher time frame PD right here that price is trading into and dropping into at 6 a.m. that you could say, okay, I'm bullish. And if you're filtering that data, that's something they should be aware of, is the fact that, okay, if you already have a pre-existing want or price action has to do this, what you're going to end up doing is filtering the data that doesn't support your bias. So like the lack of the higher time frame PD right here and the lack of the SMT at the bottom and things like that should be spotted and obviously incorporated into the idea that, okay, your bearish bias is increasing and your bullish bias is decreasing in strength and probability. So when you have this kind of one-sided delivery on the higher time frame, that strengthens your bias. So there should be no, very low support for a bullish bias and very high support for a bearish bias. That makes that day very high probability. If you have high strength for a bullish bias and high strength for a bearish bias, or low strength for a bearish bias and low strength for a bullish bias, that's what low probability is. That is 50-50. Okay, so hopefully that helps. But actually, let me go back to, I'll draw this out and you can screenshot it if you want to. But higher time frame SMT, SysD, bearish PD, bearish forming and holding. All right, I mean, you could use fractally. So at the daily high, that's true. At the session high, that's true. At the weekly high, that's true. So if you see that on any of those respective time frames, that's the kind of signatures you would look for to confirm, okay, that's the new protected high, and I can look for lower prices or higher prices after. All right. Of course. Any more questions? You can put them in the chat. Otherwise, we will wrap this up. It's already been going for an hour. I feel like these mock reviews, every single time I look at the time, like, I don't know how it goes by so fast. What does Vantix mean? How did I get the name for the model? It is there's Vanta was like something I was just I don't know. I think I was using that black, I remember, for the PDF, and from that video I was using the black PDF background. So I was just already thinking Vanta. Wow, what the heck? There's actually stuff still on here. And then I don't know, somehow it just turned into Vantix, either from ChatGPT or from someone else. But yeah, it's just like randomly pulled it out. What does the premium entail? What do you mean? No personal significance. No. It just sounded cool, to be honest. So. I low-key should. The second will be Turtle Soup. And the third one will be, I don't know. You know, it's actually crazy, off topic, but I've been getting these calls on my phone from like no name numbers, and it is these people claiming to be like the IRS, or people claiming to be like my taxes are due or something, and it is a 2-minute voicemail recording, and it is all AI. Like, I was looking at the transcript, I'm like, oh, this actually looks like something I should be concerned with, but then I listened to the actual thing, and I'm like, this is not a human. Like, it sounds like a robot. But things are getting scary, bro. I'm like, if I was 20 years or 30 years older than I am now, I would be absolutely convinced that this is a real phone call. But Yeah, man, this is my I mean, I guess it's not really off topic, but trading is going to get more and more not a necessity, but a an absolute blessing as you see people struggling with what's going to go on in the world in about, next 3 years or so. But I know you said over time you will get better at identifying breakaway gaps versus fair value gaps, busy civvies. But is there anything to look for that helps signify a gap as a breakaway gap or be used as a breakaway gap? First thing you want to look at is the proximity to the SMR. All right. If you're just looking and studying breakaway gaps, look at the inefficiencies, or not inefficiencies, the fair value gaps formed as close as you can see to some sort of SMR. Doesn't have to be the SMR of the session necessarily, but any short-term retracement or reversal will have normally a breakaway gap printing as the first one after that SMR, that delivery is finished. As you can see through this one, another short-term swing high here, this one, right? So those ones are the ones that you want to be studying. There's other ways you could look at them as breakaway gaps through balanced price ranges, but I think it's a bit more advanced. And as you just study these, that'll be the first thing you rely on for breakaway gaps. But that's the first thing I would say to study. And then as you look at inefficiencies, you want to be looking at the gaps that are leaving those areas of balanced price ranges that are obvious. So things like this, right, as it leaves this range, right? And obviously, like I said, this one on the beginning of the stream, this one is leaving this range, right? It's actually leaving that range. So those are seen as more inefficient and normally is used as gaps, gaps to trade off of compared to ones that are, like I said, leaving or nested within balanced price ranges or very close to those short-term SMRs are the ones a lot of times you see as breakaway gaps. So if you just study it like that, that'll give you a really good foundation for looking at inefficiencies the proper way. And then obviously through experience, you'll be able to narrow down it more and more and more. All right. Oh yeah. Yeah, you can't hear anything you trust by phone. You get a phone call from your daughter and then oh yeah. Yeah, that's crazy. Yeah, man, it's getting scary, but like I've after, to be honest, as soon as this I don't really partake in politics at all, but as soon as you see kind of what's going on this year with stuff around the world, I think it is just at this point it's just there's nothing important. Like especially as a trader, I think you realize a lot of this is just retail rick activities going behind the scenes just to kind of, lack of better term, scare them into submission. But at the end of the day, if it doesn't concern me or affect me in any way, why does it matter? If it doesn't affect my day to day basis and it's just nothing just but to scare me or make me hate the other side, quote unquote, nothing productive is going to come out of it. And you don't see anyone really, you'll see no one extremely successful caring about politics like that and what's going on in a worldly environment that doesn't concern themselves. So, and especially with the fact that nowadays you do not know what is real or what is not, do not really care about the news or really partake in conversations about that stuff. I know it's a very passionate topic for most, but as much as you can separate yourself from those things, you'll have a much more fulfilling life because you're no longer scared about stupid stuff, to be honest. All right. Like that's just the realist take I'm going to give you, but yeah, especially with nowadays, you could see any news thing they want. They can create, type in a sentence in ChatGPT, and you'll see it as a video nowadays, and you don't know if it's really real or not. Who's not to say that CNN or whatever big news thing that you watch is going to do the same thing? And you don't think that, if rappers in Hollywood is messed up, imagine what people who have control over entire countries are going to do just to make the things that they want to work out, you know? So take that with a grain of salt as you may, but that's my opinion. Do you have a regular broker account with stocks, ETF investments, or is that too personal? I do. I don't really do long term investments like that. My long term investment account is with E Trade. That was what I used back in the day, so I kind of just stuck with it. I say back in the day like I'm old, when I like 4 years ago. But I don't really do heavy long-term investing like that because, to be honest, like I said, I don't really know what's going to go on the next couple of years as all this stuff unfolds. It's a very weird time to be alive, given all things considered. So I don't really have any faith in long-term things anywhere. Given the fact that they're probably going to make CBDCs a thing by 2030, I don't have any faith in the US dollar, nor do I have any faith in long term holding anything. It just seems, that also is not really just the way that I invest. I'm more short term where I can see everything in front of me and nothing's going on behind the scenes. So I do, but yeah, I'm not really too invested inside of stocks, ETF stuff for long term. Flux is 40 years old. He has gray hairs. Pray for his bad knees. I do have bad knees, but about half that age. Anyways, all right. So I'll post this market review up later today. Obviously, if you have any questions about it or anything that I missed, reach out to me through the DMs. I probably won't be too active today or tomorrow, just given the weekend. But we'll have a weekly review or not weekly review, weekly outlook stream either on Sunday or Monday. Just kind of prepping for the week and kind of doing the same thing we did last week and the week before, emphasizing what days I'm looking to trade, what days I'm looking to skip, and kind of protocols for those respective days. So obviously, if you want to catch me there, I'll ping everyone and you can join up on the public stage and we'll do that. Otherwise, enjoy the rest of your weekend. I hope this review helped. Nonetheless, even if you got one little gem out of it, it's worth my time. Hopefully worth yours. So take care this weekend. Study if you have the time. Journal. Get away from the charts as well. And I will catch you guys, Lord willing, on Sunday or Monday. So take care and peace. For the 2025 IRS liability reduction program, press 1.